Hello, everyone. Thank you for tuning in to our second video of our Coffee Row Egg series titled, So You're Incorporated, Now What? Across our conversations with clients, we found many had tax and investment planning questions that were related. Our video series is going to help bring answers to those questions. Today, we're going to focus on some common things we hear when farms are thinking about incorporating, and now they've taken the next step. So again, now what?
Perfect. Well, thanks so much, Adam. My name is Matt Anhalt. I'm a senior manager specializing in agriculture services here at Virtus Group in Regina, Saskatchewan. Like Adam said, yeah, we're doing this series because these are things that we often hear throughout the lifespan of a farm company. We often hear these questions. So we just wanted to address some of the most commonly asked questions and provide some insight on these things. So let's jump right in. I'm going to start talking today about dividends or wages. Often when you're an individual, you're farming, you take whatever's left and that's your profit. Once you incorporate, that profit is actually inside of a company. And in order to get that to yourself as a shareholder, as the individual that owns the company, there's two different avenues to do that. One way is from dividends. And what dividends are is at the end of the day, when the company has earned all its income, has all of its expenses, and has paid its taxes, whatever's left in that company is what we call retained earnings. And dividends are paid out of that amount. So you can think of dividends are after corporately taxed funds are moving then to shareholders. Whereas wages, on the other hand, that's what you would receive from any employer. So that comes on a T4, and that's going to have withholdings on it. And that actually is getting paid out of pre-tax earnings out of your corporation. So what I'm going to do here is I'm going to take a look at exactly dividends and wages and what the total tax impact is on these two different ways to take your income that's earned in the farm corporation down to the individual level. So we're going to start with dividends here. So we have $100 of corporate income. The corporation then, as long as the income is earned under 500,000, so if we have 500,000 of taxable income or less, the tax rate's 11%. So we start with $100 of taxable income. We pay 11% tax on that in the corporation. We're then left with $89 of after-tax earnings in the corporation. We then will pay that down to the individual level. When the individual pays tax on it, they're going to pay at 30% approximately if they're in the middle tax bracket. So they're going to pay $26.87 of tax at the personal level. So when all is said and done, that $100 in the company, when it's flowed all the way down to the shareholder and all corporate and personal taxes have been paid, it's about 37.57%, which means for every $100, 37.7% is going to the government. That's in that middle tax bracket, remember. So $62.13 of every 100 is staying in the pocket of the individual. When we move down and we look at salaries now, so with a salary, $100 is paid out to the individual. There's no corporate tax because that's, remember, getting paid from pre-tax earned income. So that's pre-tax being paid in the corporation. So no corporate tax impact on that. But the personal tax impact is 38.5%. So $38.50 is being paid in taxes, which then we're left in our pocket $61.50. So when we compare those two, you can see it's actually pretty close. The difference is the total tax savings is 1.13%. So very, very nominal difference between taking that income as a dividend or taking it as a wage. So with that, numbers aren't always the decision factor. So we're going to go to the next slide here, and we're going to discuss some of the other factors that you have to consider and you have to put some weight to when making this decision, whether to take a wage or a dividend. So the first thing to consider, CPP contributions. Dividends don't have any CPP contributions, so there's no withholdings, and you're not building into your CPP contribution room that when you retire and you start taking CPP that you can take out. So you're going to be getting less on a regular basis because you're not contributing to CPP if you're taking dividends. If you're taking wages, the CPP is going to be withheld. So the employer has to make their CPP portion, and you have to make that same withholding as an individual. So there's a double expense there because it's in your corporation as well as at the personal, but you're building into your CPP contribution room that you can take in retirement. So that's the first thing to consider. Often we will see the next thing here with RRSP contributions is employment income is the only way, only employment income earned can build contribution room for RRSPs. So because dividends aren't treated as employment income, receiving a dividend does not build up any contribution room from a personal tax level, whereas receiving a wage does build up that contribution room. So you have to use that as a weighting of, do I want to contribute to RSPs, or am I okay with taking a dividend and not building any RSP contribution? Often, sometimes you'll see individuals kind of treat and look at their corporation as a retirement vehicle. So they might look at it, depending on the individual, this is going to be different for every case, mind you, but they'll look at their corporation and say, that's my retirement vehicle. I'm not going to contribute to RSPs, so I'm okay with taking a dividend. Some other things to consider are just the differences in the administration. So T4s require sometimes monthly, quarterly, or annual remittances being made to CRA. There's withholdings, so you have to prepare a document that says what total gross wages paid, what were the withholdings during that period, and that has to be submitted to CRA. And then you have to file a T4 remittance as well. Whereas dividends, there's no remittances made throughout the year because you're just receiving the cash. And then at the end of the year, you file a T5, what's called a T5 slip, and that reports your total dividends being paid from the corporation. As far as withholdings and installments, like I said, wages do have a withholding. CPP, the federal tax, EI, those are all withheld at the source, and the company remits those to CRA on behalf of the individual. Then when it comes personal tax time, all those withholdings have already been made, and there's often no balance or a little bit of a refund sometimes even, which is always nice, being received by the individual. Whereas with dividends, there's no withholdings, so you can get to personal tax time, and sometimes there can be a substantial tax burden in that first year, but that will have to become up. So there will be sometimes, like I say, a substantial tax burden. But what CRA will require is if you have a tax balance owing of over $3,000 in any given year of taxes paid, CRA will require personal installments to be made. So then what happens is you are making installments throughout the year, and then when you get to the end of the year, it's not such a large cash impact because you've been making payments throughout the year on the dividends. So just a few things to consider there. As you can see, it's not always just up to that tax number. There's a lot of other variables and a lot of other things to consider. So we just wanted to highlight those because this is a common question we often get. Should I take a wage or take a dividend? So thank you so much. And I'll pass it off to Adam.
Thanks, Matt. Those are really good points from a tax perspective about dividends. Now, one big thing I talk about with clients is how cash flow is king. What I mean by this is I like to have types of investments that pay clients to hold them. In other words, companies that pay clients dividends. So really, what are stock dividends? So since you have your farm corporation, you're probably familiar with the term dividend, and like what Matt mentioned here in the presentation too, but maybe not know how it relates to the stock market side of things. So simply put, a dividend is the distribution of some of a company's earnings to a class of its shareholders, as determined by the company's board of directors. So just like in your corporation, you determine the dividend, you determine when it's paid out as well. But let's say the company Enbridge, their board determines the dividend. They determine when it's actually going to be paid out. And now this dividend as well too, for the stock market side of things, can be paid out in cash or possibly in terms of additional shares of the company that get added to your portfolio. So that's kind of helps you understand what actually stock dividends are. And this is a graphic that shows just the actual progression of the funds from the company's profits, again, going to the actual shareholder. So those are dividends. Now, what companies pay dividends? So there's individual stocks that you can own, shares of, for example, Royal Bank or Suncor or Fortis. And one thing to note is that not all companies pay dividends. And the reason is because sometimes companies want to hold back the cash in their company for future growth. So a company, for example, like Apple, they actually had more cash on hand at one point than some countries around the world. But were they paying out a very high dividend? No, because they actually wanted to keep cash back for their operations, for the growth of their company. It's typically companies that are more mature, like Royal Bank, like Suncor, like Fortis, that are in utility, financial, some energy sectors that want to pay out their dividend to entice shareholders as well too. So those types of mature companies. Now, not just stocks pay dividends. There's also a type of investment called exchange traded funds, or ETFs. Now all ETFs pay dividends. Some are fixed income, so they're bond ETFs, and that pay on the interest side of things. There's real estate investment trusts, or REITs, that's partially non-qualified dividends. And this is important to know what type of investment you're putting within your farm corporation, and just know how it is going to be taxed. And that's something that I work with clients on, as well as with Matt, to really inform clients on how their investments are being taxed in their portfolio. So you understand, again, dividends, how stocks are paid. Now, what types of investments, whether it's ETFs, exchange trade funds, or the individual companies. But that's still not really a strategy for your new farm corporation, for your retirement. One approach that I take for clients is called a core satellite strategy. So simply put, you can see the graphic there, that there's a core part of your portfolio where you look at buying and holding. So technically similar, this is usually a S&P 500 or TSX index ETF. And basically what this means is it just tracks the market. So that is going to be the core that you don't sell, that basically you hold for the long term of the portfolio. Now you're going to have satellites that complement your core, which are going to be things like the cash flow is king, the dividend paying stocks. You may have a portion of precious metals in your portfolio. You might even have, other US types of companies in your account. So again, this is one approach that you can actually, a strategy, use for your farm corporation. And why would you look at this type of strategy? It's mainly because no one can time the market. Nobody has that crystal ball. Did I think we were going to be selling new crop canola at $14 a bushel? You know what? No, I really didn't. But this type of strategy is a way to take out that market timing and security selection, because long-term studies actually suggest only 2% is related to market timing. Security selection, 4%. And then asset allocation is the majority of what a portfolio, how you should be composing that portfolio. And what I mean by asset selection is really how you divide up your investments. And that's very important, is having those dividend paying investments. Again, like I said, that core, that portion of gold, how you divide things up is actually more important than picking them, because again, nobody can time the market. And I like to put that, the quote here that's on my desk, it's not what you know that will make you a success, it's what you do. So in other words, having that plan and having that process is very important. So I hope you enjoyed our video here today. Now that you have your newly formed farm corporation, you can learn about dividends, you can learn about how you can use them now, and really take the next step in your farm corporation.
Yeah, thank you, everybody. Thank you, Adam. That was all great. Thanks for watching this video. Both Adam and I have our information up there. Feel free to contact either of us. We would love to hear from you. We'd love to help you out with any questions that you have, or walking through any of these issues. So feel free to contact us. We look forward to seeing you in future videos. Thank you.